Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. Welcome to the New Home Insights podcast. I'm Dean Worley. Most of the biggest home builders in America count their existence in decades, not years. Tri Pointe Homes was born about 15 years ago in 2009, just right when the sky was falling for the housing market. So kind of a counterintuitive timing. When everybody else is picking up the pieces, they're starting this brand new premium home builder. Doug Bauer co-founded Tri Pointe at that time, and he joins us here to chat about the Tri Pointe story, how they continue to grow across the country, their approach to where and what they build and who they build for, and then also kind of his take on the state of the housing market. Doug, how are you?
Good, Dean. Thanks for having me on today.
Very glad you could make it. So let's start just a little bit about that, a little brief kind of about you first, because I know because you have a very storied career even before you started Tri Pointe Homes, and then we'll talk about kind of the Tri Pointe home story to start us off.
Well, I have been in the home building business. I keep rounding up, but somewhere between 33 and 35 years. So I'll say it in the 30s. Started actually my career with William Lyon, for 20 years. And Bill was an excellent mentor, really taught my partner, which is Tom Mitchell, everything we really learned about the home building business. So we were there for 20 years. And then we had this crazy idea. We stepped aside from Lyon and to start this new home builder, Tri Pointe Homes, with a fresh approach to the home building business. Focus on what we call is the premium lifestyle brand. Really focusing in on the product, the purchasing of land, creating placemaking. Really focus on families. I know it's kind of corny, but there's nothing more rewarding than building homes for families. So we got our start in 2009, and like you said, Dean, it was it was a little counterintuitive. Actually, my our wives looked at us and said, "You're going to start a home building company in the middle of the great financial crisis?" And oh, by the way, we kind of pushed our entire nest egg into starting that company then too. So
yeah, it wasn't. That's the way you said that. It really wasn't. I meant that. That wasn't the time where like, okay, yeah, no, things are starting to pick up. We see a pathway here. That was literally when things looked about as bleak as they ever did.
Yeah. And we never really looked back in the rearview mirror at our 15 years of history. I guess as you get older, you're supposed to get more sentimental, but hey, I'm still very excited about growing the business. But it was Tom and I've talked about it before. I figured if Tri Pointe didn't work, I'd probably get a job with another home builder or bank. I mean, my wife only told me, she goes, you'll have 3 kids to put through college. Just remember that.
So, fingers crossed.
Yeah.
So then you guys almost fairly quickly after the founding in 2009, then the market did start to turn. 2011, 12 looked a lot better, still working through some of the REO stuff like that. But, the market clearly was better. You kind of pivoted to a growth strategy, again, very quickly within the lifetime of Tri Pointe Homes. Tell us a little bit about that in 2013 and 14.
Well, we obviously started organic in 9, as you said, through 13. But in 2010, I had a relationship with Starwood Capital. And, this is a very capital intensive business. We put in our capital to start the business as a fee builder for the Irvine company. But fast forward, we got $150 million from Starwood. Barry Sternlicht's a good friend. And that really got us going from a capital standpoint. It kind of gave us the balance sheet to grow the business. And then in 2013, Barry called me up and he said, "I think we should go public." I'm like, go public? We're like this little, peanut of a home builder. He goes, yeah, go talk to Citibank. I said, okay, I'll go talk to Citibank. And lo and behold, we were the first home builder in over like 10 years to go public in January. Yeah, it was January 31st, 2013. So we went public, and so I got this currency, and I'm just a little home builder. I think our market cap was about $500 million or something. I don't know what it was. So I called up my friend Dan Fulton, who was the CEO of Weyerhaeuser. And I went up, I'll never forget it. I went up to Seattle, had dinner with him. And Dan, if you know Dan, he's very cagey, but he's a really, really nice guy, but he keeps his cards close to his vest. And I went up there with the bold ask of buying Quadrant Homes, which is one of the 5 home building brands at Weyerhaeuser. And he looked at me and he said, Doug, we're not going to do that. I said, well, if you ever decide to sell Quadrant, give me a call. Well, in 2013, it was the summer of 13, he called me back and said, hey, I think you should look at buying the entire company of Weyerhaeuser Real Estate Company.
So he changed his tune pretty quickly.
Well, he was the CEO, and Weyerhaeuser was a REIT, and they, the old adage, when things are good in home building, you spend a lot of capital. So as a REIT, they're trying to distribute their cash flow, and so they decided to liquidate. He called it a strategic objective. Looked at strategic alternatives. So long story short, I kidded with Dan. I said, Dan, that's got to be a $2 billion deal. I can't get that much money from Starwood. And he goes, well, I don't think you're going to need it from Starwood. There's a interesting angle to doing this deal. It's called a reverse Morris trust, an RMT. And basically the minnow, which is Tri Pointe, buys the whale in a reverse merger. And what we did is we bought the companies for $2.7 billion. We issued $2 billion of Tri Pointe stock. I floated a $900 million bond offering and gave $700 million of it to Weyerhaeuser. So the whole deal cost us $2.7 billion. And we closed that in July 2014, which really put us on the map.
Yeah. Oh, yeah, it did. I remember that because people forget Weyerhaeuser. They think the paper company. They owned a lot of forest. They were one of the biggest. They had Weyerhaeuser. They had Quadrant. They had Pardee, who I knew very well. They had Maracay in Phoenix. Yep. They had some stuff back east. I remember
Winchester
Texas.
back east. Winchester. Trendmaker was a big brand in Houston. Yeah.
So they were a major builder through their various brands, and for you guys, it was kind of like almost like I can't remember the guy's name, but remember the guy who he had the parking lot in downtown Boston, and that enabled him to buy the Los Angeles Dodgers from Fox. God, I'm totally drawing a blank on his name, but you immediately became one of the biggest builders in the country.
Well, it definitely made us relevant, and it was. It was an amazing transaction as you look back on it. Again, we don't look back on it much, but they did have, we had Tri Pointe as our brand, and we had 5 others. You mentioned them, Pardee, Maracay in California. We had and Nevada. We had Trendmaker in Houston, Winchester in the East Coast, and Quadrant up in Seattle.
Yeah.
So when we put all the companies together, we kept it as 6 brands initially.
Yeah. So that was the strategy. You're building as Tri Pointe, but you're also building as these various brands in various parts of the country. Then fast forward, I think it was 2021, you decided to do kind of a rebrand and have everything be Tri Pointe. What was behind that?
Well, COVID.
Oh, really? Really? For the brand? Really?
Well, no. I mean, COVID hit us early 2020. Yeah. And so Tom Mitchell, my partner here, let's back up. You have 6 home building brands, and to operate them from a sales and marketing standpoint, which you can appreciate, is a little clunky.
Yeah.
It costs. It's a little inefficient, is the best way to put it. And so Linda Mamey, who's our brilliant CMO, EVP CMO here, we all sat down and in end of 2020, we started talking about it and said, hey, how can we get more efficient in the SG&A category? Well, let's just make one brand and we eliminate marketing materials, websites, having 6 different websites, all this stuff, gets more efficient. And frankly, Dean, brand, I'm a little agnostic on brand. Brand is earned over time. Actually, if you look at the 6 brands, I think Part E has the best brand recognition because it had been around the longest, right?
Yeah.
And
had a very good reputation too.
Yeah. And so we actually debated internally. I actually called a CEO friend of mine at another public home builder, and I asked his opinion, and he goes, well, I'd call it Trend Maker. I go, Trend Maker? He goes, oh, yeah, that's the best brand in Texas. I said, but what would be the best brand in the U.S.?
Yeah.
And so we really came down to say, hey, we were this new home builder. We started in 2009. We came with a fresh approach to product, to how we build and how we recruit people and the culture of our company and a focus on the customer. So let's call it Tri Pointe. And frankly, in my mind, brand like Tri Pointe's, it's only earned over time. It is kind of cool we don't have any egos here, but it is kind of cool to go to Texas and the Carolinas and say, hey, I bought a Tri Pointe house. Well, that's cool, right? But it's earned over time. So we consolidated them all into one in 21.
But you guys had earned that though. Because I remember we all have an idea. Market analysts know what builders have their best reputation. And I think almost every major builder now, it used to be the product was kind of on a scale of 0 to 100. You had stuff in the 20s and 30s, and the 70s and 80s. Most folks build really good homes across the country. Any major builder is building a really good home. But even above that, you guys did have kind of an above average reputation for your product in 2021 when you rebranded those folks. So I would argue that at that time, Tri Pointe probably would have been the best brand to have chosen from that perspective.
Obviously, I would agree with you.
Yeah. So you're growing. You grew exponentially almost through the Weyerhaeuser purchase. Now, though, more recently, you guys have been growing pretty dramatically in some of the big, stronger markets in the Southeast. What's the motivation for that? I think I know, but go ahead and walk us through how you're growing now more organically by expansion.
Well, I'll back up a little bit. When we looked at, we were kind of obviously founded in California, so we have a very strong presence in California. We do roughly 6,000 closings a year. California, I know different rankings. We're obviously on a combined basis, probably top 3 or 4 builder in California in deliveries. I think we'll do about 3,000 or so, or 2,500. And that's going to go on for the rest of my future with the company. But what I and Tom said, hey, we got to grow the business outside of California and push east, Phoenix east. So we pushed into Texas and we organically went into Austin. We bought a small builder in DFW. It was so small, we ended up basically bringing in all our people. We had Houston already with Trendmaker, which is obviously Tri Pointe. So we started really pushing Dean growth in Phoenix East. Maracay obviously was gone. We were at Tri Pointe in Phoenix. Yeah. But then we organically started in Raleigh and Charlotte, led by Gray Shell in Charlotte and Bob Davenport in Raleigh. And those markets are just growing like a weed. Great markets to be in. And then lastly, we kept studying the Northwest. We looked at Oregon, we looked at Boise, and we looked at Utah. And we decided on Utah. Primarily, you're only as good as the people that you have or you hire, your leadership. And our leader up in the state of Washington, Ken Kravanek, is actually from Utah. He knows everybody. I mean, we were over there months ago. He is the most well-connected person in Salt Lake. So he's going to lead that charge. We're still in Washington. And then the other markets that we were studying, and looking to expand was the coastal Carolinas, which is really connected with our Charlotte operation a little bit. It's a few hours, a little southeast, and Florida. We're not in Florida, and Mitchell kept telling me I'm not too old to keep doing another organic play because I kept looking at acquisitions.
Okay.
Because it's obviously more immediate. The good thing about organic is we have a playbook. You hire the right leader, you hire the right team concurrently with buying land, and you don't incur a lot of what I call dumb tax because you're not paying a premium, you're paying book value for land, and you're slowly growing versus if I went and bought Dean Home Builders and you already had 10 communities, but then I found out that I overpaid you by 200%. So that we like the organic approach. So yes, we just expanded. We have Joel Underwood heading up Orlando. I was just there last week. A few weeks before that, I was in the coastal Carolinas, which will be kind of Charleston to Savannah, led by Allie Heavener. And then we've got Ken running Utah. So that kind of completes our playbook right now. Are we going to go anywhere else? Never say never, but we've got that lined up right now.
North Dakota, or is that on the horizon?
No.
Okay,
no,
that's a callback to it.
Tom told me I should look at Nashville. I think he wants to go to Nashville so he can go to listen to good country music. That's
everybody wants to go to Nashville right now. Nashville is actually smoking hot right now. It's a very, very cool place and a very, very hot market too. Other parts of Tennessee is very strong. Were any of those markets kind of you waffled the most, or the toughest calls in that process?
No. I mean, it takes us a while. We're very deliberate in how we want to find the right leader who fits our culture. Culture at Tri Pointe is really, really important to Tom and I and throughout the company. I mean, we've been not obvious, but we've received a lot of designations as a great place to work and other Fortune magazine stuff. But when you have a strong culture, that really helps feed this premium brand strategy that we have of producing great homes for families. And so we are very deliberate when we're looking for Orlando or looking for Utah or looking for coastal Carolinas to make sure we had the right leader in the seat to lead us and grow us in those markets. So there's not a big hesitation to it. It's more of a process. We're just looking for the right team, because if you have the right team and you don't have a lot of turnover, you're going to have a lot of success.
Would you not go into a market, even if the metrics, which is my next question, what are the metrics that you're looking at, job growth? Would you hesitate to go in a market, though, if you could not find the right leader or the right team for that market?
Yeah. I mean, we've hesitated because we didn't have the right team, but I would argue, and we use obviously all of the Burns market data, advertisement for John Burns and Dean, everybody. But I mean, we look at all the data that you guys provide us and look at it and say, well, we love Orlando. We like the coastal Carolinas. They've got strong job growth. Yeah. They've got a strong employment base. They have great businesses. They have great education systems. They have a favorable tax basis, stuff like that. And, if you look at the smile states, and I'm not getting political, but to be honest with you, the red states have become a very strong housing market across the country. There's a reason for that. They're very pro-growth, pro-business.
Yeah. That you might have just answered, but let me check my next question, which is are there constraints to where you grow? What is that red flag in a given market that you're thinking about that would make you hesitate the most? Is it that the political landscape of that market?
I call the barriers to entry on the land side. Yeah, for sure. Yep.
So if their entitlement takes forever, if they have kind of anti-growth sentiment, you're going to be hesitant to go into that market.
Well, and you would say California is probably the poster child for all that, but
for sure,
we've cut our teeth here for 30 plus years, so we know how to get our way through those barriers to entry. But if you have other markets that are not as robust as that the smile states, as I keep referring to, and don't have and have significant barriers to entry, yeah, we would definitely not pursue that right now.
Yeah, I figured. What's the most interesting lesson you've learned in this growth process, especially the organic stuff? Is something that stuck out? Say, next time we'll be thinking more about that.
Yeah, it's a great question, and it's real simple. It's finding the right leader.
Okay.
And if you find the right leader, and I call that a division president. We're very flat here. We have 15. Well, now we have 17 divisions. We don't have regional presidents. Half report to Doug, half report to Tom. So we also have our other job of playing CEO and president and all the public company stuff. But we both were division presidents, so we're very involved in a macro way with the divisions. But the biggest lesson that Tom and I always are critical of ourselves is if we have the wrong leader in that position. Frankly, I'll pick on Austin.
Okay.
I picked somebody internally, great person, great guy, because I love to promote from within, but he didn't have what I call the it factor to attract, retain, and build a division. He was really just really good at construction. So it's always, Dean, the thing that I'm most critical of myself is picking or having the wrong person in the wrong seat in the bus, as I always refer it to. We've been batting a pretty good average. I think we bat in the 90% range, but we're not perfect.
That's not bad. That's not bad at all. I guess issue is with that is you often aren't going to know if that's the right person until they've gone through for some time.
It takes a minimum of 6 to 12 months to know that you pick the right person.
Yeah.
But we hope we check every box along the way. But yeah, you like I said, none of us are perfect.
No. How much bigger are you going to be next year than this year, do you think? In whatever metric, sales, community count?
Well, we're public, so we told the street, and I tell you that we'll see community count grow 10% by the end of 2025. We're not looking to be the biggest builder in each of our markets, in each of our divisions. How we look at scale is we like to be relevant and be in the top 10 from deliveries. And reason for that, it's not what happens when you get a relevant basis of deliveries. It helps with buying land because you're relevant. It helps with attracting subcontractors because you're relevant. You have repeat business. It helps attracting people because you're relevant in the market. So I use that term relevant in kind of a broad way. It obviously helps with your financial performance too. But again, we're not going into any of the markets saying, I want to be Lennar or Horton. I mean, they can have the number 1 or 2 spot all day long.
That's actually a good segue for our next kind of, I guess, module. Let's talk about your approach. Some builders are more pace oriented, and let's be honest, the bigger you are, the more volume oriented you kind of have to be. Or do you think of yourself as pace oriented? That is how the velocity of your sales. You think of yourself as price oriented. Are you always trying to balance those two considerations?
Great question, and it's really a balance. I mean, we're actually, I think I mentioned this at the Burns conference. I mean, there's Toll. That's the highest ASP of the public builders. We're number 2 in the high 6s, low 7s. I think we were 712 in the first quarter. Our ASP close, but we, even at our ASP and even with the product execution, we actually focus on pace. I mean, we like to. I mean, I've told the street this. We're focused on about a 3.5 as a company absorption pace. That's pretty good for a move. An entry level premium first and second move up builder. Our cycle times, I'm very proud of our cycle times too. They average 115 days. So that's just under 6 months. So we're very not only in tune with product development and pace and watching margin, but we're also very cognizant of cycle time and return. So there's so many levers, as you know, better than anybody that you have to pull. But pace and price is really equally balanced, and it's done community by community.
And just for listeners throughout lots of the country, remember when Doug said that their ASP is high sixes? Remember, they have a big presence in California, so that number is not as dramatic as it might seem in parts of the country. How about in terms of your buyer segments, your focus? You've mentioned families a couple of times. Who are the buyer segments you are most cognizant of that you need to please to make it work?
Well, again, we've taken a look at that. When we bought the Weyerhaeuser companies, we had a big asset down in San Diego called Pacific Highlands Ranch, and all that product was $1 million to $3 million, and it printed money for years. And so intentionally, we have, even in California, you look at the Inland Empire with all the land that we still own with Weyerhaeuser, that's all entry level. I mean, that's $400,000 to $600,000 entry level product that because we have such a great land basis. But our focus is pretty balanced, Dean, between I call entry level premium, first and second move up. And even when you look at absorptions for the first quarter, entry level I think was at 4.0 exactly, but even first move up and second was maybe in the mid to high threes. Our active adult was actually, which is small portion. It was closer to 4, but overall, we like a balanced approach between entry-level premium, first and second move up. We'll do a little luxury here and there if we have to, but we've really gotten entirely out of the luxury segment. I'll leave that to Toll.
Okay. Is there anything you're doing right now to get folks to sign on the dotted line? Is it a concession? Is it a type of concession? What's kind of working the best right now? What tactic, I guess?
It's a multiple number of levers you pull. I mean, one of the things that, is the most important lever is our focus on land in core locations, close to employment, great schools. I call it main and main. I think Doug Yearley calls it the same thing, but we don't buy in tertiary markets. So, the consumer starts their buying process online. Every consumer does. Yeah. I mean, and we have a very robust online presence, but when you're focusing on core locations and then you focus on product that fits that core location, that site, and design the right product, whether it's attached or detached, and give the consumer some choice, even though, we still sell 65% of our orders are spec homes, but the consumer usually has some choice along that path. So that's really what we do to focus the consumer in. Now, we have incentives, as I reported in the first quarter.
Yeah.
Off the top of my head, I think our incentives were 3.8. About half of it goes to closing costs and half goes to financing. Our buyer profile, they make some pretty good money. I mean, their average income is $195,000, and they're a little agnostic to where the rate environment is. And I mentioned this the other day at your conference. They're really focusing on product, location, and the experience that they can have buying a home from Tri Pointe.
So at 7% right now for a typical mortgage rate 30-year across the country. From your perspective, that's not quite the negative that a lot of folks maybe perceive that to be.
It isn't.
Ease that out a little bit?
Well, again, our buyer profile is very well equipped to deal with the current mortgage environment. We've been in this environment for some time now. And I think one of the biggest drivers for the new home builders, and I think you guys noted in some of your research somewhere, but the new home builders' share of total home sales, you know this better than I do, Dean, I think it's gone from like 15 to 30+%.
Yeah, even a little less below 13 to 30+ of available homes. Yeah, it's dramatically increased.
And when I'm out, I was on the East Coast last week. I was in Texas 2 weeks ago, and I'm always walking product and talking to our sales teams. And the consumer, I mentioned this also. 2/3 of our average mortgage is $500,000. 2/3 of our buyers are millennials, and Gen Zs. Gen Zs are about 10 to 15% of that,
Okay.
2/3. But they are very well equipped to buy homes today, and that's really our focus.
It does amaze me how much because I try to walk product as much as I can when we're doing our market feasibility studies, and you hear a lot from agents that you know what they don't really they're using that incentive money for closing more often than buy downs. That's it, and now that mortgage rates have kind of slid back a little bit here these last week plus.
Well, and the buyers are not as in tune with where the 10-year Treasury is trading every day like you and I are. Frankly, the buyers, especially the cultural buyer, the Indian buyer profile is a very significant portion of our buyers in Houston, D.C., Washington. I mean, they're usually very in the tech business or engineers of sort. They prefer to have their incentives in the form of a price adjustment
Okay.
than even financing because they do very well. They're not worried about a 6.5%, 7% mortgage rate.
Okay, that's yeah. I mean that answers. That's one of. I'm glad you said that because that helps me figure out why that has been. So it seems counterintuitive that a lot of new home buyers aren't going more for the buy down when they have that option.
But getting back to the what I was trying to point out is in if I tell you you could be the CEO of Tri Pointe and your major competitor, which historically has been the resale market, is not trading about 1 million homes a year or trading less than 1 million homes that they normally trade, would you be happy or sad?
I'd be ecstatic.
Yeah. So, I hate to say I'm a fan for higher rates, but there's another macro thing that I think, despite what the Fed wants to do, is we've got, unfortunately, a fiscal crisis here in the U.S. I'm not, going to pontificate on my economics theories, but there's a lot of debt that we need to keep financing. And guess what? The investor that wants to buy that debt is going to want a return.
Yeah.
So you're not going to see treasuries go down. I don't think, at least my lifetime left in running this company, back down to the 2-3%.
Yeah. Yeah. I don't think, yeah, that's, but also remember, they also have to finance that deficit and higher interest rates make that more expensive for the government.
And that's the flip side. So there's going to be, I think the 10-year and the financing rates are going to be kind of stuck where they are for the time being.
So kind of stable mortgage rates, you think?
I call it hey, if you look at the 30-year average of mortgage rates, and I could be wrong on this, but I think it's like 6.5%.
It depends on how long you go back. If you go back far enough, it's almost 8.
Is it? Okay. You know better than me. But, where we are in mortgage rates right now is very, very similar to what history has been here in the U.S.
Doug, is there any product type you won't do? For instance, is there a density that is just too dense for a Tri Pointe?
I'll simplify it. A quick answer: podium.
Okay.
Yeah, from a real high density standpoint, Tom and I have messed around with it, but when I look at, I'm also the financial brain here, and I just get hung up with the amount of capital that I need to invest in a podium and have it kind of sit there for such a long time before it turns. And so that's probably the one product I could probably safely say we will not do.
Okay. Yeah, it is expensive, and not every sub knows how to do it or do it well.
Well, that's the other problem. Yeah.
How about in terms of your approach to internally into your business? Are you very much, hey, we've got the right person in that market, we're going to let them go, we're very entrepreneurial, or is Tri Pointe a little more top down and let's kind of follow a script? Are you somewhere in between of that?
We're not top down at all. As I mentioned, Tom and I play regional presidents, and so we've got a lot of things going on. I look at this. I want to hire the best division president. We have very little turnover in that area. I'm going to pay you very well, and I'm going to empower you with a capital allocation to go invest. And I learned this from General Lyon. I was the CFO at Lyon, and I told him I want to go run Northern California. And he looked at me and he said, son, you don't know the difference between a 2x4 and a flying saucer, but that's the best idea you've had. And he said, I'm going to send you to Northern California. You're going to run that division. I'm going to give enough rope. And then if you hang yourself, you're out.
So, no pressure.
No pressure. And so a little of that we're very entrepreneurial. I mean, I just hung up with our division president in Raleigh, and we've got a big land deal we've been discussing. And, we're here. We call it the best of big and small. We've got the home office that provides the capital, the human resources, the IT, the legal support, some of the marketing, a lot of the marketing. But you as a division president are running a $300 to $400 or $500 million business.
Yeah.
And we set you up with a business plan. We set you up with capital, and you got to perform. And if you don't perform, then we got to talk. I mean, it's really that simple.
You kind of have 17 pretty sizable local builders effectively.
Totally. Because when I said the best of big and small, the best of big provides the capital. But I can tell you, I was in Dallas a couple weeks ago, and that is a very local market. And the biggest raw material that we are always focused on is what, Dean? Land.
Yeah.
But I tell you what, our Dallas-Fort Worth team has incredible relationships. So that's the best of local. Then I need to come in and say, hey, this is a good deal. How do we give you the capital to build this thing out? And that's basically I could say this because I'm running Tri Pointe. I think the best job as a division president in this industry, and we've recruited several of them from other builders, is working for Tri Pointe because of the entrepreneurial spirit. There's not some robotic corporate initiative coming down every day. Now, do we have certain things that we want to, simplify and streamline? Yeah. I mean, we're a public company. We're always looking for SG&A efficiencies, but running this business is a very local business.
So in the market, just briefly, how has the spring selling season 2024 been for you so far? Just FYI, we're recording this in mid-May. How's it gone so far?
Yeah, I mean, we just reported Q1 and through April, and I think our sales pace we recorded was about 3.9 absorption pace. That's sales per community per month, and we're very consistent with April, and we'll be reporting here in the next quarter. But the consumer still is very engaged.
And you guys are still getting the price you want, and your incentives seem pretty flat.
Yeah, we gave our guidance. We trended our guidance for the year with slightly higher margin improvement. So, that would definitely imply that you've got a tighter bandwidth on incentives and costs and stuff like that.
We talked about this at the summit that you have referenced a couple of times, but what's happening in your world with costs, with hard costs, not land costs, but your hard costs, your verticals?
Very flat to maybe up 2%. I know the summit had the little clickers to make that poll. I think the poll was 2 to 3% or something.
Yeah, it was it was pretty stable.
Yeah, I can tell you it's been very flat.
That's good to hear.
Flat to 2%.
Flat to 2%. That's a world better than it was a couple of years ago, and even more recent than that. So that's
for sure.
That's good trend. Two more. Let's just do this. What worries you? I'm going to ask you a sort of a negative and positive. Let's start the negative so we end on the positive. But what worries you more than anything else about, let's say, in the next year or so?
What worries me over the next 12 months is this coming election and the potential risk of that being a big distraction for the consumer, which we've actually factored into our business plan. And then geopolitical risk. I'm a very interested party of what's going on in the Middle East and Europe and so forth. And none of us control that, but could that cause some significant derailment? Not uncommon, but like a pandemic or some other risk that happens. Yeah. I'm just cognizant of it. But on the plus side, I would say my outlook for housing, we kind of talked about it with where rates are, and then there's all these other impediments that are in front of housing, the regulatory environment on land and the scarcity of land, the scarcity. I mean, labor isn't getting any younger, but I think that the home builders, the public home builders, have a very good runway for the next 3 to 5 years. And for Tri Pointe in particular, and I mentioned this at the summit, our runway at our price point and our focus on product execution and this premium brand strategy all the way through the customer experience really puts us in a lane a lot of times to ourselves, which I think bodes well for our growth as well. And lastly, for the financial community that may be listening to this podcast, our focus, and I think I mentioned this at the summit, growing book value per share 10 to 15% a year. We've since 2015 compounded annually, it's gone up 15% per year. And I know there's been a lot of talk about multiples changing for builders and this and that. We're a small cap home builder. Yeah, we do about $4 billion in revenues and over 6,000 deliveries. But if I told you could own a stock and its book value grows 10 to 15% a year, I hope you'd want to buy it.
Yeah. Yeah. I love that $4 billion is just, we're not that much. Very modest. Just $4 billion. That's all. Well, Doug, I really appreciate you coming on and joining us for the podcast.
Well, thank you. It was great. Always love talking to you and absolutely love the Burns organization. You guys are so vital to us and everything we do. So I really appreciate everything.
2 commercials in one podcast, completely unsolicited. Thank you so much. I appreciate it.
They didn't even pay me.
No, we did not. We did not. Thank you too for listening, listeners. This is Dean Worley for the New Home Insights podcast. We'll hopefully see you again in a couple of weeks.